Hi everyone, and welcome back. In this session, I'm going to be looking at execution skills, and more so in as much as the style of execution, our mindset to a degree, on how we use our order book, how we place orders in the market, and how we execute around price. Now, apologies if some of this is a bit basic, but I feel it's the best way of explaining really what I mean, and the overall message towards the end of the session is all about adaptability, and with markets changing dynamics very, very regularly of late, that's something we really need to apply to our trading. So I'm going to start looking at the passive side of trading, and really this is if we were adopting a kind of market maker style. And as we see here, just on the simple bid offer price that we look at every day, I have widened this just for ease of example. And this looks a little bit like a sterling dollar price. You know, we have the left-hand side bid where someone in the market, a market maker, is prepared to pay for sterling and sell dollars, and that's at 112.50. And similarly, on the right-hand side is another market maker potentially who's willing to sell at 52. And in between there, we have a 2-pip spread. And that's important because, you know, that's something we either choose to try and retain if we're in a passive mode, or we're willing to pay away if we move more into an aggressive mode. Now, if we continue with this passive side of things, and this would be as much if we feel maybe a little bit in control of the market, if we feel there's less volatility, if we're trending maybe, then we can afford to allow the market to maybe come to us. And by that, I mean, you know, simply if we're short and the market, we feel the market's going down on a fairly, you know, regular basis, we may wait and choose not to deal at that price at 50.52, which was a current market level, and we may leave a resting order a bit lower in the market. In this example, I've put a resting order down there at 112.22. So this would be if I was short and comfortable with the market coming to me. It could also be that I want to buy on a dip, but I don't particularly want to jump in at the market level currently. So I may use that resting offer a bit lower. And as you see there, you know, there'll be layers of bids sitting out there with other market makers at 48, 47, etc., etc. And exactly the same scenario will be on the right-hand side. And if this instance, I was long, comfortable with the market, I felt it was going to keep nudging higher. I didn't necessarily want to trade at the current market rate. And I'd layer an offer up there. I've got it here at 112.72. That's my offer. You'll see there's potentially some other offers in there from other market makers on the way up. So effectively, what I'm trying to do is not pay away the spread, and I want the market come to me so I can maybe buy a little bit cheaper and sell a bit higher. And that all sounds great, and that sounds like we should be doing that all the time. But the simple fact is, by doing this, we do not guarantee execution. If we choose to try and trade at a slightly better level, be it a buyer or a seller, we are not guaranteed execution until the market moves and another market participant is willing to trade at this level. And just quite simply there, as we see a chart, you know, as the market moved back down, if we were that buyer and we managed to put a bid in at 112.22, the market did come to us and we got that trade done, but only at that point when the market came to us. But if we'd have been that seller up there at 112.72, even though the market rallied, it still hasn't rallied to that level. And so we have not traded at 112.72. And as daft as this seems, lots of people actually think if I put this order in, I'm going to get traded on. You know, it's not that case. It doesn't mean to say the market may not move up to that level. It's just a bit of patience and potentially, as you see there, going through a little bit of pain before it gets there. But the key message here is you have an ability to trade at a better level if you're reading the market right, if volatility maybe is a little bit less and you're trending. And we should use that because that's a good part of our trading. That's smart trading. And if I move on to the other side of things, let's say where the kind of market taker. We're the aggressor in this situation. And the reason we're doing that is because we want that certainty of trade. I want to basically be able to trade at current market levels. I want to get my deal done so I can be comfortable that if I'm selling, I'm short. If I'm buying, I'm long. Quite simple. And what happens there is I have to go to market. And in this instance, quite simply, if I want to buy, then I have to go to the market where someone is willing to offer. And that will be on the right-hand side. And so in this instance, I'm buying at 112.52. And if I was the other way around, I'd be selling, and I have to go to the left-hand side where someone else is buying. And as you see from the graphic there, we are crossing the spread. So in this instance, each time I trade, I'm paying away 2 ticks, but I'm guaranteed to trade. And, you know, in lots of instances, when you move to a more aggressive style of trading like this, where you want guaranteed trade, whilst you can't ignore the spread because it will be part of your cost of transaction, sometimes people get hung up on that spread and they say, I'm not going to pay away that spread. I'm going to try and get a bit cute and I'm going to offer at 112.51 if I'm selling. Again, you're being passive there and you have no guarantee of trade. So you've got to hit that bid at 50, pay away that 2 pip spread. You are the aggressor in the market, but you have a guaranteed trade on board. So if I try and put this into context of markets and seeing how we can use these different styles, well, on the left-hand side there, we basically have the sterling market, and it comes from a couple of Fridays ago. And basically, if we'd have been sitting there long, let's say we're long down in the low 115s, and we feel the market's moving, you know, the tea leaves are telling us there's not too much volatility into the market. It's nudging higher into the weekend. And basically, other market participants are buyers. Well, if that's the situation, I don't want to be selling down there in the 115, low 115s if I feel it's going up. So what do? I hold back and I leave some passive resting orders up in the market so I can sell and take advantage of the market coming to me. And in this instance, just by example, if I'm trying to take profit as it moves up, I maybe want to layer 50% of my risk to sell at 115.85 and another 50% at 116.05, take my profit. I've let the market come to me. I've sat passively in the market. And that clearly would have been proved worthwhile. I've not paid away any spreads. Thank you very much. Job well done. But as we move on from this, if we were to adopt exactly the same style, and let's say in this example, we set ourselves our sights a little bit higher, and we were looking for this to continue, maybe up into the 116.50s or whatever. So we even never got to any sell levels that we wanted, or we kept riding that tide. And as we went into a Friday close, we thought it was closing nice and positive. So we stayed with our long position. But then we come across the weekend and we don't hear of any particular news that's going to frighten me or whatever. So the market opens up. We're still long of this market. And we're a little bit disappointed. It opens in Asia a little bit lower at 115.82, but we're still not seeing anything that's telling us our long position is wrong. But again, maybe a slight change of mindset. Maybe we get a little bit more defensive because it hasn't opened and gapped a bit higher. So quite sensibly, we could be thinking, okay, well, let's put a bit of an offer in at 116.20. We put it just below Friday's high at 116.23. Everything we're doing at the moment is smart. We're passive still. We're letting the market hopefully come to us. And it does start nudging a bit higher, and we see a high of 116.13. But we don't quite get to our sell level. Is there anything telling us that we're doing anything wrong at this moment? Absolutely not. We should be reasonably comfortable. But here's the rub. As the market moves into Europe, all of a sudden, potentially we've broken a bit of a support level there at 115.82 from a previous high. And all of a sudden the market starts accelerating. Increased volatility comes in. We've got a major reversal of the previous move. Now, what I see far too many times from traders is that what they'll do is, from having an offer up there at 116.20, they'll see the market move lower and they'll bring their offer down to 116 the figure. And similarly, as we break here at 115.82, and as you can see, it's quite an aggressive sell-off, they'll probably move their offer down at 115.75. What's happening here is you're remaining passive when the market dynamics have changed. They've moved from a bid market to an offered market. You are a seller. You are passive when you're selling into a bid market, but all of a sudden, if you're trying to sell into an offered market, this strategy will not work. And so this is where you need to be adaptive to how the market conditions change. And this is also to protect the intrinsic value that you have sitting in this position. So if you remain passive, you're going to sit and watch it go all the way down to 114.76, and you'll be cursing yourself. But what you should be doing here, because mentally, you're going to lose confidence and you will keep nudging it down in a hope that it bounces. We don't deal off of hope. We deal off of forward-looking views and smarts. And what you should be doing here is quite simply hitting the bid. You cross that spread. You don't worry about that 2 ticks. That's irrelevant. You'd rather be selling and paying away 2 ticks than not selling, because your passive orders aren't getting executed and it's 100 ticks lower. So you should be hitting that bid. The smart people would probably be looking at that chart line, 115.82, using that trigger as the time for you to bail out of your long position, protect some of your intrinsic value, and sell at 115.70, 75, whatever. The key message here is you are the aggressor. You go to the market, you hit the bid, and basically you pay away the spread. So hopefully that shows you, how we need to adapt. There are good times in the market where being passive will add us a few more ticks. We'll sit there nice and confident in what we're doing, but there are other times where we have to respond and react. And that's when we have to be brave and hit those bids and just get out of things. And sometimes that's taking a stop loss, and they're hard to take. We all know that, but that is equally and probably more important for you to get on that aggressive side. Other instances where you can be on the aggressive side, as we've seen here, we've done it, to sell out a long position, but we might want to have a trading strategy where when we break through that support line, we feel that's going to be a trigger to accelerate the move. And again, we have to be aggressive for that trading strategy to get that short position on board. Remember, the market has changed its mentality, and now we're seeing some longs capitulate and potentially some fresh shorts going into the market, and they're going to be aggressive to get that short trade on board. So, there's some opportunities to get into new trades, and obviously how you handle existing risk, but it's clear that we need to adapt, and we need to adapt and change from being a passive trader into being an aggressive trader as and when the market dictates.